Okay, so today is where we take every single thing we've been kind of learning and we put it all together to make, the inversion model. So first off, we're going to start off with what you actually need. We have a checklist right here of what you actually need in order to be able to enter, right? So first off, you need to have, and this should be obvious, you need to have a drawn liquidity, right? Before you enter any trade, you should always have an idea of, hey, what am I targeting? Why am I in this trade? What am I looking for? What am I looking to be hit, right? You want to have a reason to be in the trade, because if you don't know why you're in the trade, then you shouldn't be in the trade to begin with, right? So first off, you want to find a drawn liquidity, whether that's a previous day high, previous day low. Maybe you have a data high, a data low, London high, Asia high, whatever it is. You want to find some kind of draw. Maybe it's an unfilled, higher time frame gap, something that you're targeting that makes sense that you think price is drawing towards, right? Then you want to find some sort of delivery, right? So what is delivery? Delivery is basically any PD array, so like a fair value gap, an order block, etc. I use fair value gaps mainly. I don't really use order blocks very often. I see them, but personally I don't really like use them. It's very, very rare that I'll take a trade off of delivery from an order block. I'll find an example right here for a second. I would never like take this trade because we're already super high up. Actually, I would take this one. This one's not terrible. Basically, right, so we go in, we tag, there's no 15, we tag down in this 5 minute, all of these 5 minutes actually, but this one got respected and this one got respected, these two got respected. So now we have delivery. So if we're looking for price to go higher, obviously fair value gaps are one of the key confluences that would help to push price in the direction that it's going. So we go down here, fill some orders, push price back higher. You want to be going with the trend, right? The trend is your friend. So it'd be a little bit of a cooked entry, but if you were to enter right here, put the stops below the inversion, right? And then target, let's say you just went for like a 1-to-1, you have delivery from these two 5 minute gaps down here. So you have delivery. You wanted us to go higher. Let's say there's some highs up here we didn't hit. So, there's these highs. I'm sure there's more. There's these highs over here, right? So, like, let's say that's your draw. You're targeting out those highs. Okay, cool. You got your delivery, 1. You got your inversion, 2. I'm going to go more in depth, but I just want to make sure we have the full checklist done before I, fully go more in depth. But anyway, delivery. You need something to be able to push price higher. So we're going up, we retrace into what to push us higher, a fair value gap, and then we push higher off of it. It shouldn't be too complicated. Like, don't overcomplicate it. It's just as simple as that. So, like, if we tag into a fair value gap and we push off of it, that could be a form of delivery, right? Or that is a form of delivery. The next thing we're really looking for is you obviously want to find a inversion to trade off of, right? So you would drop to the lower time frame. Now, when we're looking for delivery, I forgot to mention this. When we're looking for delivery, you want delivery from I would say for beginners, 3 minute and up. So like a 3 minute gap to deliver us higher, a 5 minute gap to deliver us higher, a 15 minute gap to deliver us higher, a 30 minute, and an hourly, in some cases a 4 hour, right? For people who are starting out, I would say 3 and up. For people who are more advanced, I would definitely say you can definitely use 2 minute delivery. It takes a certain, I guess, eye to be able to discern which 2 minutes are going to actually work and which aren't. Which is why I say maybe give it a little bit of time before you start doing 2 minutes, because if you start throwing 2 minutes in there, I say the same thing about like 30-second IFEGs. Like, there's a ton of 30-second IFEGs. People who are experienced can trade them well and make money off of them, and people who aren't, they're just going to get chopped up. So I say if you're a beginner learning this and you've barely ever traded before, I would say just focus on, like 3 minute or higher. If you are more advanced, or once you get more advanced, I'd say go from 2 minute or higher. So 2 minute, 3 minute, 5 minute, 15 minute, 30 minute, hourly, mainly all those. Like, that's the kind of delivery you're going to be looking for. Now, when you're entering, I only enter off of the 30-second time frame, the 1 minute, the 2 minute, the 3 minute, and the 5 minute. So that's it. So like, you're looking for lower for your inversion and then higher for your delivery. So you want 3 minute or higher for your delivery, and you want like 5-minute or lower for your inversion, right? Again, when you're more advanced, I would say you could go to the 30-second chart and try that out. But again, I would take some time before you do that because you're just going to end up entering a lot of extra trades. And you want to make sure that you really fully have the strategy entirely down and you know how to trade really well before you do that, right? You don't want to end up taking extra losses just because you're trying to jump the gun. Trading isn't a rush at all. Then what you're going to do is, it's kind of hard to show because the markets are closed right now, but also not really because it's kind of a simple thing to understand. You do not really want to enter an inversion until it has closed because it's not valid until it's closed, right? If we're looking to enter once we disrespect this gap and then we enter right when price goes up here because we really think it's going to go up, it doesn't really matter because what we could do is easily wick into this, have it look super good, and then the candle, and you enter right here because we're up here, and then the candle closes down here, and then we end up dumping, and then you take a loss because you didn't wait long enough, right? There will be a lot of times where we'll just go into gaps, like, you know, a great example of, you know, like right here, for example. Let's say you wanted shorts. You know, we went up here. I guarantee there's some kind of delivery. Yeah, so this wick right here, we wicked into a 15-minute. Okay, cool. You know, you go down to the lower time frame, and then you look at the 5-minute time frame because you want to take the highest time frame gap there is. You know, higher time frames hold more power. So if we inverse the gap with the highest power, it is the most likely to fail, or the most likely to go in our direction, I should say. Like, you know, if you're trading against the fair value gap, you want the fair value gap to close. That's the whole point. So right here we had a 5-minute that was still holding us up. This looks super good. You know, at the moment, you know, price was all the way down here. You're like, this is definitely going to fail. Like 100% this is going to fail. And then what do? We end up manipulating all the way down here and then pulling all the way back up, right? So if anybody who entered here was like, yeah, this is definitely going to inverse for sure, just got wrecked. And that's a great example of why you want to just wait for it to close so you actually have that confirmation, right? But anyway, moving on. So first off, you want to key draw on liquidity. Second off, you want to have a higher time frame fair value gap to deliver us to the draw, right? Third, you want to have an inversion that is a 5-minute or lower. And like I said before, you want delivery that is a 3-minute or higher. And then you want to make sure that you're waiting for the candle to close. You don't want to prematurely enter a trade and take a loss just because you had FOMO and you couldn't wait to get in the trade. You want to make sure that you enter when you're supposed to. Other than that, you want to just let your trade play out and manage it well. And I'm going to show you how I manage my trades and go break even when I do. So let's get into a few examples of that. I went on FX Replay just because it's a lot easier to find examples. Because I can just replay it and it doesn't snap me back in time every single time I go back and change time frames. Anyways, so I wanted to show an example of, like, obviously an A+ setup. So for this example, we have a London high up here. We end up manipulating lower right here, end up tagging into this 5-minute gap to deliver higher. So we have a higher time frame delivery. We have a clear draw of London high. We have a inversion of a 2-minute gap down here. I accidentally skipped too far ahead. This is what I was trying to show. We have a 2-minute gap right here to inverse, right? We swept these lows right here. So we have a liquidity sweep. We have a bullish bias in the higher time frame. We have a draw. We have delivery. You know, it looks solid, right? We have a V shape, which is what I talked about in the last video when we were going over inversions. Have a V-shaped closure, right? Close that with one candle. Oops, I didn't mean to do that. Okay, wait a minute. Okay, cool. Closed it with one swift candle, right? We put our stops to the lows. We would target London high, right? So this would be a 4-hour trade. Obviously, we'd enter the trade. Okay, cool. And then we let it play out. So in this scenario, I would wait to go break even until we hit this external high up here, which we do right there. So I'd go break even here. I usually take a little bit off, usually not 25%. I just didn't feel like managing it, like typing it in. Usually I take a very, very small partial at my break-even point just to cover fees. So usually it's like 1 micro or something like very small. And then you kind of just let the trade play out. Now, I didn't check whether or not this fully plays out. Oh, we trail right probably here, just in case. Okay. This is taking forever to play out, but you get the deal. Okay. Trailed a little too soon. Whatever. If you look at that trade, right, we have an A plus trade. Why? Why do we have an A plus trade? First off, we have a very, very solid draw on liquidity, which is London highs, right? This London high has not been, touched. You go to the higher time frame, we are overall bullish. We had a very V-shaped rejection. There's probably a 4-hour right here. So we're delivering higher time frame from a 4-hour gap. If you go to the 5-minute, like we were just talking about, we left equal highs right here, which is a perfect spot for a break even. We had a manipulation into a 5-minute down here. So a 5-minute gap to deliver us higher. So we had a high time frame fair value gap to deliver us higher. We had a lower time frame 2-minute gap, which, like I said, I said that about delivery. In terms of like 2-minute inversions, those are completely solid to take. So we had, like I said, higher time frame delivery, had a good narrative to go higher, had a good draw, manipulated into a 5-minute gap, had a solid V-shaped 2-minute, which is the best way that you want to have it, went straight to our break-even point. I go break-even at the first internal high. In this case, technically on the 2-minute, it would be right here, but it's just, in my opinion right here, just from having experience, I would trail to this. I would wait for this high because I've seen us like go in and create like a gap right here, tag back into it before, and then push off plenty of times. So in my experience, I would wait to go break even. And then, we went up, took the equal highs out right here, which is amazing for our break even. And then the rest of the trade just played out. It took a little bit of time, but it played out, and then it played out to the full draw. So, there's one example. Okay, so another great example right here. So we go into the day. If you look in the daily time frame, we have a unfilled daily gap right here, which is a very, very solid draw on liquidity. An unfilled daily gap is solid because not only would the low always be a previous day low, which is a draw in itself, but now we have an unfilled gap, which needs to be filled, in my opinion, for us to go higher. So in this case, it's 9:40 a.m. We manipulate higher. Then we have a very solid V shape downwards, right? Now, you would enter off the candle closure of this, and then you'd put your stops wherever, makes sense to you. And in this circumstance, I'd probably leave it a little lower, but the technical correct placement would be right here. And then you would get a 1.44 risk to reward. So you look at this, and then you have manipulation into, we have delivery from 2 15-minute gaps, probably a 30 as well. We have manipulation higher. We swept out these highs right here. We are delivering from a 30-minute gap to deliver us lower. We have previous day low as a solid draw lower. And then we have a 5-minute inversion with a really solid like doom candle, like V shape. So again, V shape to the downside. We would enter right here. We'd place our stops at the highs. It'll let me enter. Okay, cool. Place our stops to those high. Okay, it's still not working. There. Place order. Cool. Put our stops at those highs, and then we let it play out. Now, in this example, I wouldn't wait all the way for us to go down here to go break even. I'd probably end up going break even at this first internal low right here. So I'd leave this. Okay, cool. Now I'm break even. Okay, so you would have gotten break even on this, which there's nothing wrong with this. I'm just demonstrating A plus setups. I haven't even watched if this one fully plays out or not. Okay, it looks like it gets close. Even closer. Okay, this is just going to take forever. I'd say this is a weird price action kind of a day, but eventually it plays out. So after a whole lot of chop on this day, it ends up playing out. Now, your entry still would have been protected. You never would have technically gotten stopped out. Now, in this circumstance, I would have gone break even. I would have taken that break even 10 times out of 10, just because there are times where we'll do stuff like this, and then we'll manipulate back up, and we'll just take your stop, and we'll stop hunt you. That happens plenty of times. So going break even helps to, preserve capital, even though in this circumstance it would have ended up playing out. Yeah. it would be safer to just protect your capital because that's the name of the game, right? Even if you miss out on making some money, at least you didn't lose anything. So you just go back in with the same amount that you had. That's why going break even helps a lot. But again, if we go over this trade, we have 1, a clear draw on liquidity, 2, delivery from a higher time frame gap, so 15 minutes and 30 minutes. We have a very, very solid V shape, which is what we look for. We have the highest time frame gap of the current trading leg gets inversed. We have a clear break-even point. We have a clear draw. Like, everything's solid, right? Now, you'd wait till the candle closes. The candle closes below the gap right here. So you put your stops to the high, like I said, and then you would target your draw. You know, that's an A+ solid setup. I'm going to go find one more. Okay, so next example. Right here, we had a news play. So not a news play, sorry. News hit at 8:30. We ended up pushing higher off of news. 9:30 ended up manipulating a little bit lower. And then we have an SMT at those lows right down there. You can see that ES is a lot lower down. So ES, we're roughly down here where we are on NQ. And on NQ, we're up here. So obviously an SMT at this internal gap. We have a 5-minute delivery to the buy side. We also have 15-minute delivery. We also have 30-minute delivery, etc. Sorry. And we just look super bullish, right? We have a draw across. We have an hourly unfilled gap across up here. That's what this line is. And then we also have a previous day high up here as well. So my first target would definitely be this. And then if I were to have runners, I would leave it to this buy side right here. So I'm going to take this 5-minute gap. So again, clear draw on liquidity right here. We have delivery from a 15-minute, 30-minute, and 5-minute gap here. We have printed a long wick of rejection right here. And we have a very, very solid V shape of the highest time frame gap of the current trading leg, which is the 5-minute, right? So we would enter off of that, put our longs right here. I wouldn't put my stop. I wouldn't put my stop all the way to this low down here. I'd probably put it down here. Just because in this circumstance, like if we do come down here, we're probably just going to draw towards this wick anyway. So it's kind of just, you know, it's just a waste of extra R. So you could play it to this first internal high for a 1R. You could play it here for probably about a 2, a little over a 2. You know, if you really wanted to be ballsy, you could play it up to here to this previous day high. That's a 5. I haven't played this trade out, so I don't know what we're going to do exactly yet, but let's find out. So right here, I'm just going to target this unfilled hourly. I'm probably going to take a partial off at this high if we hit it. And in this circumstance, you don't really have a perfect break even unless you go break even at this high, technically. Like, this could technically be a TP. I mean, this would be your break even if you were targeting higher. But, like, let's say you were just targeting right here. You don't really have a technical break even point. So you kind of, over time, you'll be able to develop more of kind of a discernment for when you should and shouldn't go break even. So in this circumstance, you don't really have an internal high. You just have the external high up here. So either A, you just kind of wait for us to form more structure, and then, you know, like in certain circumstances, what I'll do is something like this. If we go up here and then come back down and then we go back up and take this internal high that we made, I'll just go break even because I don't really want to see us reverse off of that, especially if we've already retraced a little bit and kept pushing off. So I'll do something like that. But again, I'm just going to let this trade play out. Solid play in my eyes. Granted, if we did want to go lower, obviously we still could, but I have a bullish narrative for this play. So let's find out. Okay, so one candle, we end up going to the high. Well, I guess one 5-minute candle technically. So in this circumstance, I'd probably take off about 50% just because we hit a 1R. And I don't know if we really want to go down because we made an SMT with this high at ES. NQ's leading right now, though. So I'm just going to leave that, and we're going to see what happens. Okay, ended up being break even. So, solid trade, nothing wrong with that. Might end up running it out anyway. I'm kind of curious. Okay, now. So break even ended up saving us. We didn't end up running out the full external highs, but we did take it to that first high, which was about a 1R, and we took about 50% off there, so we still made some money. But yeah, I mean, these are just like a few examples of, you know, solid setup, solid plays that you could definitely take. Right here we have an SMT, we have delivery, we have a draw higher, we have a reason to go higher. We have a V-shaped 5-minute. So not a bad play at all. But, you know, that's what you're looking for. You're looking for that base checklist of, you know, like, what's your draw, first off? You know, what are we delivering from to push us towards that draw? Do you have a solid lower time frame inversion? Are we gonna inverse it in one candle, or are we gonna? That's another thing I forgot to mention. If we take a long time to inverse something, it becomes with every single candle increasingly less probable. So if we do it in one candle, it's usually like the most probable. If we do it in two, still probable. Nothing's wrong with that. Three, a little bit lower on the probabilities, and then four, and usually anything past four, I won't really even take. I'll usually just let it go, because if we're chopping and we're taking that long, we want to be with the momentum. We don't want to be like, super duper slow, choppy, upwards and then enter. So anything more than four candles, I would usually skip on. And yeah, so that's basically just what you're looking for. You want a clear bias, you want a clear delivery, you want a clear draw, you want a clear inversion to take, you want a V-shape inversion. SMT is just the cherry on top. And make sure you're not entering the trade too early. Make sure you're waiting for that inversion to close. And then if you're doing all those things, and you obviously are going to take some time to kind of figure out exactly how it works, but if you take that time and you go practice this, you go back test it, you go forward test it, over time you are going to become, I mean, not financial advice, I'm not promising anything, but over time, from what I've seen with the results that I've had with people, teaching people, a lot of people, most people end up getting an understanding of it, and this strategy does work. I use it on a day-to-day basis. I make money all the time using it. And I mean, yeah, that's just how it kind of works. That's what you're looking for. So that's all I got for this video. I'm going to make I'm going to make more videos on, different things regarding what you're looking for, and just a bunch of different other things. I have more videos coming to finish off the boot camp, but this is kind of just the baseline, right? So you have, these beginner confluences, we break a structure, candlesticks, time frame, just basic kind of stuff. Then you have IFEGs, you have fair value gaps, you have all of it. And then, you kind of take the pieces, you mold them together, and then you create a model. I'm not going to sit here and pretend like this is some brand new super duper thing that I came up with myself. I'm not. I learned from ICT. Pretty much all of this is just ICT concepts. It's just how I trade it in particular. But yeah, I mean, this is something that has worked very, very well for me. I'm pretty positive that if you work at it, it could definitely work for you as well. And yeah, that's all I got. So go find some examples, and I'll see you next time.